Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
24 in review, 25 what's new. Recently, I went to a funeral. I was reminded of the date of this person's birth as well as the date of the death. And the question is the dash that's in between the two. So January 1st, 2024 to December 31st, 2024, the dash in between is what makes the difference. And that's what we're going to talk about today. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. And today we're talking about 24 in review, 2025, what's new. Can you believe it's 2025 already?
Crazy, right? Where did the year go? Time just flies.
We were on a call the other day. We were talking about how crazy it was. You remember 2000, and it was 1999, and it was about to turn 2000, and everyone thought the world was going to end. And we were out working that night trying to fix up a generator so we could have power in the new year, and finally just gave up. And what do you know, 2000 rolled around and everything was fine, and now it's 25 years later.
Yeah, crazy, right? I mean, it's amazing, and as I think about you and your siblings, how much older you're all getting, I don't understand it. You guys are getting older, but I'm not, so that's a crazy thing. You guys are 25 years older. But anyway, yeah, so, let's look at this, kind of like, it's important to look backwards and review history, and be able to learn history. And that's a real cool thing. As today, when I was reading the Bible and I came across this verse in Job that says, "Please inquire of past generations and consider the things searched out by their fathers. For we are only of yesterday and know nothing, because our days on earth are as a shadow. Will they not teach you and tell you and bring forth words from their minds?" So, we look at history so that we can learn from history, and we'll be able to learn, and it will teach us things, as that says. And so that's what we want to do today. That's what we want to do today on today's show, is help people to be able to learn from the past. And, as they say, if you don't know history, you're doomed to repeat it. But we don't want anybody to repeat any of the bad stuff. But it's kind of an interesting thing that to look at the market. Some people would say, well, financially speaking, 2024 was a very good year in the market. And, when you look at the S&P 500, it was a really good year. I mean, it did in the vicinity of 25% for the year or thereabouts. But, the question is that, how does that compare to the previous 2 years and some of the other things, and what else is there out there?
Return, when you look at the return, right, you can't just look at a total return. You can't just say, you have to look at how many units of risk you're taking on for that return, right? Right. And so you're right, 25 sounds amazing, 25%. Who doesn't want 25%? But when you say that gold outperformed that, then that puts it into perspective, right? Because gold has a lot less risk than the S&P 500. So what we can get into a lot of those metrics. What do you compare it to? Do you compare it to individual stocks? You compare it to something like Palantir that did 350%, right? Everything is in perspective.
Right.
At 25%, it sounds real good. But when you also think about the fact that S&P now is about 33% in 7 stocks, that doesn't sound so diversified.
No, not at all. That sounds kind of scary if you ask me.
Yeah.
Right.
Yeah. So in a lot of ways, 2024 was a really volatile year, right?
Yeah.
It may not have been so much in the S&P 500, but fixed income, it was crazy volatile. And when we look at the political aspect, it was very volatile. When we look at natural disasters, it was a volatile year. It was a very volatile year in a lot of different ways.
Yeah. Yeah, that's actually absolutely true, Daniel. Appreciate you bringing up all those all those things, because a lot of times people, I would have told you before the elections happened that no matter which candidate got in, I could understand how the market could go up or the market could go down with either candidate, right? And it's not so much the candidate, and the candidate does play a part. And, President Trump, won obviously from that standpoint, and he plays a part in that. But, now, the markets, they could go up or they could go down. Or he could tell you reasons why both of those things could happen, because he doesn't control everything. He's a contributing factor to it, but not the case. But all these other things in the past year, and it goes back to that old equation of his event plus your response to the event equals the outcome. So 2024 was a very volatile year, and now we're on the other end of it, and we have an outcome. Good or bad, it is what it is, because that's where we're at. But the point is that to be able to learn from it, to be able to look at it and review that. Talking about reviewing that, we have a paper that we'd love to give you that goes along today's show called "The Importance of Financial Defense," and this paper is able to help people to understand that you can't just always play offense. You got to have some defense in there. And isn't the saying, Daniel, defense wins championships, right?
Yeah.
So, so with that, we need to be able to, and when we're talking about somebody's retirement, we're talking about championships. So you listen to Financial Strategies with Andrew and Daniel Agemy, and today's topic is 24 in review, 2025, what's new? And we'd love to give you this paper, The Importance of Financial Defense. You can have it by calling us at 800-725-7616 for your free copy, 800-725-7616. Call now. Today's topic, 2024 in review, 2025, what's new? Because people don't know what people don't know. And stay tuned to learn. So, Daniel, as we look at this, and as you said, it's very volatile. 2024 was a very volatile year, not just in markets, but all the way around with politically and events that were happening and all those different kinds of things. What else? What do you see, when we look at 2024? You want to get into some specifics of that?
Well, we went through some different returns, right? Because you'll talk to somebody and say, well, my 401k did 25%. That's pretty good. And that is pretty good. But when we look at markets, and you're talking about looking historically, right?
Right.
What's happened? When we see towards the end of a cycle, a 25% year, 23% the year before, it's starting to look long-winded. And people will say things like, put your money in S&P. If I had to become a millionaire again, I'd just put all my money in the S&P. And that sounds really good. It's a good story. But we need to examine, is that true? Because what does history say about that? That was the same thing that happened in Japan in the 1990s, where it was the best performing stock market, and it just would only go up. It would only go up, only go up, only go up. And people were taking loans out against their homes, taking loans out to buy more stocks. And what do you think that did? Well, if you take money out and put it into a limited amount supply of stock or real estate, because Japan had both going on at the same time, the real estate market and the stock market, it just went up and went up and went up until it didn't. And then it crashed, and it took 30 years to get back to even. We look at the Great Depression. It was the same thing. When people start thinking risk is my friend, risk is my friend, risk is my friend, which happens the longer you get into economic boom, the more you need to be careful. Now, could we have another 25% year in 2025? Could we have a 50% year? Hey, it's possible. Would it be my forecast? Probably not, but it's absolutely possible, because crazy things happen when you get towards ends of cycles. We can look at the Great Depression. The same thing happened where stocks would only go up. So then people would take margin loans. And they'd take loans against their stock and buy a stock, and then it'd go up. So then they could take another loan against their stock, and it's to go up. And that's partly why people lost so much, was because they were taking loans against their stock, and then it'd go up, and they do it again, and they do it again. And the same thing we can look, if we look at, in the tech bubble crash in 2000.
That's right.
Through 2002, right? That time frame, it just got crazier and crazier. And people just started saying, risk is my friend, risk is my friend. And so we're not saying like sell everything. We're saying learn from history, be wise. Right. Be wise. What are the alternatives? Do some research. What are the alternatives? Because when something goes on for so long and it just goes up, when people think 15% annualized returns are normal in the S&P 500, that's when you have to look at history, right?
Right.
And you say for 150 years, if it did 9%, and the last, since 2011, it's done 15% or whatever it's been, 12%, is that sustainable? When 7 stocks made up all the returns in 2024,
right,
and it's 33% of the 500 stock index, you have to say, is that sustainable? So be wise. We can look at alternative stuff you and I talk about all the time. You know, a BDC, one of our favorite BDCs in 2024, total return, income plus growth, did 33%.
Wow.
Right?
Nice. Sweet.
So there's other things. We talked about gold outperformed in 2024. We talked about some of these good BDCs outperformed. Some of our favorite stocks like Texas Pacific Land. We talked about Palantir. If you want risk and you want some serious risk, you could have invested in Bitcoin too, right?
Yeah,
Which
right.
you didn't do 25%, but it did about 125%. So when you're looking back, look at cycles. Look at what you can expect for a period of time, and then also look at what your alternatives would have been. Could you have gotten more return for less risk? Or if you just love risk, could you have gone more risky and done a lot better return and had a better risk-adjusted return?
Good, excellent information, Daniel. Excellent. And you know, one of things I think about when you're saying all these things, Daniel, is the aspect of you know, people who are doing it themselves, or they hire an advisor, and the advisor is not much better than doing it themselves. You know, the kind of like the advisor is not really advising. Sometimes you have to advise your advisor, and those aren't good places to be in. So there's a lot of, this is a great time with the market being high, because you know, to be able to reevaluate. And that's the whole purpose of today's show, right? Is to evaluate what happened in 2024 and what do you want to happen in 2025, and is it going to fit your perspective? And so today on the show, we have a book that goes along with today's show that called Retirement Income Source, the ultimate guide to eternal income. Now, when you're in retirement, you don't need growth as much as you need income. Everybody wants their money to grow, and that's assumed, but you need income. You need a paycheck that's going to last for the rest of your life, eternally, for at least for your lifetime, right? And so we'd love to put this in your hand by our friend David Scranton, the Retirement Income Source, the ultimate guide to eternal income. Yours for the next 5 first-time callers at 800-725-7616 for free, no obligation. Call us 800-725-7616 for your free copy of the Retirement Income Source, the ultimate guide to eternal income. This is David Scranton's newest book, and I think it is his 4th, actually it's probably 4th or 5th book at total, but we'd love to put this in your hand, free copy, 800-725-7616, and we'll be right back after this.
Do you have any questions for me about Retirement Income Source?
You know, I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you, so you can enjoy your retirement. It's a little more income stability.
I'm in.
That's 2 out of 3.
This is Financial Strategies with Andrew and Daniel Agemy.
We're in this group having investment conversation, talking about different types of investment, kind of like a mastermind, talking about different types of investment. There's a couple, you know, late 20-year-olds that have done pretty well for themselves, and they're talking about how dividends are a waste of company money, and how it's a waste. All these dividend stocks, all these dividend funds are a waste of your capital. You need to be in growth. And that's why NASDAQ has outperformed all dividend stuff for the last 10 years. And they just keep talking about it and talking about it. And there's a 70-something-year-old sitting there, and he says, you know, you guys know everything, But once you get to a certain age, what you realize is you made all the money you need. You made all the money you'll ever need. And what you want to do is you want to protect it. You want to get paid from your assets, and you're not so concerned about turning the money, doubling the money or tripling the money. What you want to do is you want to protect what you have and then collect a certain amount of return off of it. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy. And today's topic is 2024 in review and 2025, what's new? And we're glad that you joined us today because people don't know what people don't know. And that's why we exist, is be able to educate people, to be able to make smart decisions on purpose. Daniel, that's a great illustration of what it's like as people get older, that the situation changes, right? Just like when, you were a child, you went to a pediatrician. Now that you're an adult, you're going to a regular doctor. And why? It's that because a regular doctor does things differently than a pediatrician. And the same thing when people are growing their money, it's one thing. Investing in NASDAQ's good with growing your money. But then when you get older and you made your money, the risk, and this is what you brought up in the last segment, right? Is that what was the risk that you're putting forth for the gain that you're getting, and is the worst risk the risk worth the reward? Very key elements as we look back to 2024 and then on to 2025. When I look at 2024, Daniel, and I see how the S&P came up, 25 plus or so percent in 2024, but I look back in January 2022. To January 1st, 2022 to January 1st, 2024, the market actually went down and it came back up. And, it was, kind of a flat time historically, if you just look at the numbers, right? The S&P was at one place in 2022, January 2022, and then another place, same place in January 2024. So those 2 years went by, and if you didn't buy more shares during that period of time, your money didn't grow for those 2 years. And so if you divide the 25% over 3 years, that's only 8% or so. So, it's not always what people seem it to be.
Wow. Well, that is probably very new to people if they look back at history and see that over those 3 years, it's only about 8% return.
Right.
I think you get into some fights if you told people that they only made that if they were in the S&P 500.
Right, exactly. And but people, it's really funny, right? Because, January of 22, the market went down for basically all of 22, and then 23 to 24 it went up, but it just was coming back to where it was. So people forget that they lost money in 2022. They say they made money 23 when actually if they didn't buy any more shares, they were just getting their money back. And then they actually didn't make any money till 2024. So it's kind of interesting how averages fool us, right? Or percent and percentage fool us, right? It's like I say, to our radio audience, Daniel and I, we run an average of 10 miles a week each. And you say, do you really? Boy, Andrew, you don't look like you're a runner. I say, yeah, well, he runs 20 and I sit on the couch and watch, and averages fool us, right? But that is the average, right? 10 miles a week. So anyway, as we're looking at this stuff, again, we're not trying to badmouth the S&P. We're just trying to help people be aware of things. Like Daniel said earlier, a very key point I want to bring out that I'm not sure if I can say it the way you said it, Daniel, but 7 stocks comprise most of the S&P 500. 33% of the S&P 500. That's not real good diversification from that standpoint. But
let's talk about S&P for a second here, because a lot of people don't know that the idea of index funds, and you've got a story about Warren Buffett talking about index funds, but the idea of especially S&P 500 index fund was you're buying the best, right? You're buying the best 500 companies in America. And the criteria to get those companies in there is a good criteria, and it makes a lot of sense. The difficulty comes in when everyone's doing that. So if you're doing that and you're piggybacking on the research of individual stock pickers, then what ends up happening is you're benefiting from all the best. But when the S&P becomes the market, what ends up happening is there's a lot of good individual stocks you can buy that people just don't invest in because it's not in the index, or it's going to be put into the index, or things like that. And the S&P becomes the market. What ends up happening is no one's doing fundamental research, or I shouldn't say no one. The market doesn't have fundamental research. It's an algorithm. There's an algorithm that says, I have money, therefore it goes in the S&P. And what ends up happening is, instead of the dog being the market wagging the tail, the S&P 500, the tail's wagging the dog. The S&P is the market because more people are investing in indexes than people are doing individual research. And it becomes fornicated, it becomes bifurcated, right? Because now there's not individual research. And so these are things you need to look back in history, look at the Nifty 50, look at things like that where it became that way, where people say this is the only way to make money. And it's a good idea when it starts out, but the thought process gets destroyed because everyone's doing it. It doesn't work anymore.
Yeah. And that's a very good point, Daniel. That's why, we have a paper called Hard Lessons of the Stock Market that we love to put in your hand so that you can learn from stock market history. And yes, there is money to be made in the stock market, but, it's not always as easy and simple as people may think it to be. So we love to put this paper in your hand. You're listening to Financial Strategies with Andrew and Daniel Agemy. And today's topic is 2024 in review and 2025, what's new. We have this paper to go along with that. Hard Lessons of the Stock Market. Yours for free by calling us at 800-725-7616. 800-725-7616. Daniel, when you're talking about the market like that, I'm reminded of a quote by Michael W. Green. When he, in his research, he says, and I quote, indexing can be like following a crowd into a crowded room without checking if the floor can hold everyone. It ignores fundamental research and can lead to market inefficiencies and significant corrections, unquote. And, that's the thing, right? That it's following the herd. And, it doesn't always go up. People out there will say it does go up. And Daniel, I'm going to correct you. You said, the 500 best stocks. It's not the 500 best stocks, 500 largest companies, right? Because there's a lot of other stocks that are better than that. And that's what we like to focus on, is the best stocks. If we're dealing with stocks, we like to work with the best stocks, right? I mean, that's one reason why we invested in Pelletier, and that's why we invested in the stocks of Texas Land and what is Pacific Texas, whatever that company is.
Texas Pacific Land.
Texas Pacific Land, yeah. And, there are ones that we invest in because we see them as being better than the average market and then the average stock from that standpoint. And we like to give true diversification to people. But, so 2024, looking in review, when you just look at the straight numbers of it and what the market did during only 2024, hey, looks great, right? But go a little bit wider than that. Go back 3 years. And what did it really do? And, the average being in the 8 to 9% range, which is the average of the S&P over 150 years, right? But then the big question is, as we finish up the first half of the show today, Daniel, right? And we're segueing into the second half when, let's talk about, the 20, we may do some more in regard to the fixed income market perhaps, but, also looking toward 2025, what's new and what's going on with that. But what do that's kind of what I'm thinking, or what happened with bonds and bond funds in 2024?
So just like the S&P 500, the S&P 500 becoming fornicated, right? It was a good idea when it started, and in 500 companies, you had a lot of sectors, you had a lot of diversification, you had materials, you had mining, you had energy, you had all these things, and now it's basically tech. And you're not getting exposure to a diversified basket of stocks. Like we said, not only are you not getting exposure to different sectors, you're not getting exposure. You are 33% basically in 7 stocks.
Right.
Bond funds work kind of like that as well, where the way that they allocate cash to bond funds is the better that bond does, the more money has to go into it. So what ends up happening as bonds go over par, which means you're not going to get your principal back, all your principal back. They have to put more money into it. So at the end of 23, we're talking about, we thought 2024 would be advantageous to be a stock picker. And I think that turned out to be perfect, right? Not only a stock picker, but a bond picker. Because if you look at bond funds, they didn't have great returns for 2024. But if you had traded individual bonds, you did real well. Because the bond market, the radio listening audience can't see this, but the bond market did like this, right? Rates went up, yields went high, they came way in, then they went back up. And so if you were trading bonds, you had bonds come due, you had a lot of cash coming in the portfolio. What you could end up doing was take advantage of those, right? So we started with low duration, then we went out in duration, then we sold some duration, and then we went out in duration again. And that lowers your volatility and increases the certainty of your returns, right? And it's really tricky what's going to happen in 2025. It's real tricky what happens in 25. But what I am certain is if you're picking individual bonds and you're picking individual stocks, you'll still outperform what indexes are doing because you're lowering your risk and you're increasing the certainty of your return. Now, everybody doesn't have the ability to do that. I understand that. But then if you're not going to hire a professional to help you, what you should do is you should look for fund managers, right, that have good track records that you can get into their funds and let them pick them. But don't do the indexes. So either get professional help, somebody who knows how to pick them, get the education you need so you can learn how to pick them, or find a fund that has a good track record of picking individual stocks. Don't get involved with the bond indexes or the stock indexes.
Right. Good advice. Good advice, Daniel. Well, you listen to Financial Strategies with Andrew and Daniel Agemy. It's time for us to take a break here. And before we do our break, we want to give you a book written by friend David Scranton, Retirement Income Source, the ultimate guide to eternal income. Income that you need when you retire to be able to replace that paycheck so that you can live the rest of your life and not run out of money. Love to be able to give you this book for free to the next 5 first-time callers at 800-725-7616, 800-725-7616 for your free copy of Retirement Income Source, the ultimate guide to eternal income. Call now, and we'll be right back after this.
This is Financial Strategies with Andrew and Daniel Agemy.
Daniel, I remember when I was about 4 years old, being in church and, in the nursery or whatever it was there, and we played the game, musical chairs, and I just loved that game, right? And didn't always like being without a chair, but I loved that game. When the music stops, everybody grab a chair, and somebody's without a chair. And unfortunately, I believe that can very well happen to many people that are investing in the S&P 500 and in some of the stocks that they are. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. And today we're talking about 2024 in review, 2025, what's new?
Daniel, we just talked about Michael Green's quote about indexing can be like following a crowd in a crowded room without checking if the floor can hold you, right? And that's also, in my mind, the S&P 500 is investing in. That's kind of like a game of musical chairs, and when the music stops, it's going to keep growing until it doesn't. Right? It did in 2024, and it may do that in 2025, but then it doesn't, like you said earlier, just like what happened in 1999, right? Things were going really crazy. And then in 2000, bang, and the music stopped, and there were people without a chair, and many people lost 30, 40, 50% of their portfolio at that time, and it took 5 to 7 years for it to come back. But if they were still working, that wasn't a big deal because they didn't need the money, right? But if you're in retirement, that's a huge deal. Warren Buffett has been touted as saying that most people will do well by investing in S&P 500 funds, right? Passive index funds, because the expenses are low. And again, he says most people, right? Because most people don't know what they're doing. But not all people, right? And if you're one of the not alls and you lose money, how's that going to feel, right? So that's very problematic. And one of the things, was very interesting because Warren Buffett, in the article I was reading, was saying that, professional financial people want, are touting their wares, so to speak, and what they have to offer, but it's hard to beat the index. And, I think that's interesting. He says that because, think about it for a minute. Doesn't he have own portions of many of the companies in the S&P 500, right? And so then he stands to benefit from people putting in the S&P, because when you invest in the S&P 500, stocks have to be bought. Even if they're not worth, if they're $100 share and they're not worth $100 share, they have to be bought, and so then they become worth $500. They become worth $100 a share. So it's just a very interesting thing, and that's why people have to be able to know what they don't know, so that they can make smart decisions on purpose rather than just following their crowd.
Yeah, exactly. I think that Michael Green quote. If anybody doesn't know who Michael Green is and they have any interest on indexing and what we're talking about, look the guy up, because the work he's put in research on passive investing is insane, and it will blow your mind. But part of why that roof collapsing is such a big deal is everyone thinks they have X amount of money. So if you're in a fund that's 10% in Apple, and 10% in Microsoft, and 10% in Tesla, and 10% in Meta, and 10% in NVIDIA, or you're in S&P 500, or you're in funds that are in all the same stocks that S&P 500 is, and your account is worth $1 million, how much is your account really worth? If you went and sold it today, you'd probably be fine. But if you sold it on the same day everyone else was trying to sell it, you have no idea what that would go for. And that's another thing he's talking about, the problem of indexing. There's no liquidity. Everyone thinks there's liquidity, and there is liquidity if you're the only one doing it. But if something changed, this was part of the problem in Japan. If more retirees start deciding to retire, and they decide that collecting a 7% return in fixed income is better than trying to get a 9% average in the S&P 500, and they start selling it and there's less money coming in, it drives it down. It's the same thing if you look at Jeff Bezos or Elon Musk. They're worth how many billions of dollars? Well, if Elon tried to sell all his Tesla, what do you think would happen to this shit? He's not worth that. He does not have liquidity to get a Tesla. He can't sell his Tesla without driving the price down to who knows what. Same with Bezos and Amazon. If he tried to sell all his Amazon stock, who knows how low the stock would go. There's not liquidity to support that. So some of this with that roof collapsing is people do not know how far that could go. If some event happened, that would drive that price down. And it's interesting you bring up Buffett, because Buffett just keeps selling his stocks and going more and more into cash. And he's been wrong. People say he's wrong, because he's been doing this for a few years now. but he doesn't know when things will turn around, but he's been doing this a long time, and he's got a hunch that we're closer to the end of the cycle than the beginning of the cycle. And he doesn't like his risk profile of staying in stocks like Bank of America or Apple. He'd rather have his money in a treasury bond where he can get close to 5% than have it in these things. And so he keeps liquidating and going more to cash. And that's what we're talking about, looking at your units of risk and seeing if it makes sense where you are. Maybe it does, maybe it doesn't, but you need to look at it and decide, does where I am make sense still? It made sense maybe when you got in. Does it still make sense? Right, AAA?
Right, exactly. And that's why we have this paper, Hard Lessons of the Stock Market, things that you can learn from other people's mistakes, right? I've always taught you, Daniel, and your siblings, right, that the best way to learn is by learning from the experience of other people, so you don't have to go through those same mistakes. And that's what we want you and our listening audience to do, Hard Lessons of the Stock Market. We have this paper for free at 800-725-7616 for your free copy, 800-725-7616, because people don't know what people don't know. And if you read this paper, you're going to learn some things that a lot of other people don't know, and you won't have to be part of the herd and doing what everybody else is happening. So we'd love to put that in your hand. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 2024 in review, 2025, what's new? Daniel, as we're talking about that, and you were talking about, in 2024, opportunities that came, there was some volatility in the fixed income market, and you took advantage, you were able to sell high. The whole thing about investing, business in general, right, is buy low, sell high, right? I mean, you go to a gas station, they buy gas cheap, and then they sell it to you for more, right? Walmart does the same thing. Restaurants, they buy food, they fix it up, they sell it for more, right? It's real interesting, all this. Oh, what I wanted to say is that, I was at the Mecum auction recently here, and, it was a buyer's market at the Mecum auction. And you could get some cars at, actually, two things were happening, right? Number one was cars weren't hitting their reserve, so they weren't selling. And secondarily, you could get some cars at some really good prices for those people that wanted just to sell the car. And this is unlike the past 2 or 3 years that I went to the auction. Past 2 or 3 years that I went to the auction, it was a seller's market. And cars were selling for big money, really big money. And you know what the difference is between the two? In the previous years, the stock market wasn't doing so well. So people said, well, let's buy cars and invest in cars and do, because we can make money on the cars. Whereas now the stock market's doing well, and people are saying, well, I'm just going to leave it in the stock market. Well, that is certainly an option that people can do. But the whole thing about investing is buy low, sell high. And when you're talking about bonds, we like to do that same thing. We like to buy low and sell high, and then buy it back again when it goes low again, right? and we have this little system that you do that works pretty well. A lot of time, I'm not 100%, but most of the time, right? And we like it. What you like? Tell us about this treasure hunting. We have a couple minutes left in this segment. Tell us a little bit about the treasure hunting that you were able to do in 2024, and will that be available, do you think, for us in 2025?
Well, there's always deals, right? There's always deals. It's just you have to look in the right spot to find the deals. There's not a deal maybe every single day, but there's always deals. And it's difficult sometimes to think things will change. So the housing market in Colorado, for example, people in 2021, it just seemed like housing could only go up. It's always going to be a seller's market, right? Houses is just going to go up, hold on to it. And now people are having difficulty getting what they want for houses, for rent, for things like that, right? So you go through these cycles, and fixed income has done that a lot the last few years. It's partly because of what the Treasury Secretary has been doing. It's partly because of what the rates have been doing. And when we talk about what's new in 2025, there's a whole new administration. There's a new Treasury Secretary. For right now, the Fed chair will stay the same, but maybe in 2026 there will be a new one, and so there's a lot of changes. And the past administration was doing some weird things with the way they were funding the Treasury, funding the government. They were doing it all on short-term notes. They weren't issuing any long-term paper, which caused some bifurcations. And that's partly what was providing these opportunities. No one knew what was happening with rates. And when no one knows what's going on, there's always some mispriced security. So people kept saying rates are going to cut, rates are going to cut. And I remember having a conversation with you. We had some bonds we really liked. And we sat down and we said, do we sell these things? Right? We've made a lot of money on these. They've gone up. So the way bonds work is when interest rates go down, the value of your bond goes up, all things being equal, because now people want that return, that coupon that you have. And when rates go up, your bond is less valuable. So all things being equal, the value of your bond goes down. And so you can get appreciation. Now, if you just hold it to maturity, none of that matters because you know when you bought it what you'll get in return. But there's some trading that can happen in between. If you're paying attention, you know what you're doing. And so we're always looking for these mispriced things. And so we had all this appreciation on some bonds, and they weren't paying anything that was special, right? We could get, at that time, we could get close to 5% in a money market account or a 1-year treasury. These were longer duration, but they were paying, like 4.95%. And we said it doesn't make sense. It was hard to do because you always think like, well, it'll keep doing what it's done. We'll keep doing appreciation. So I think it was around July, August, we sold out of a bunch of stuff, had all this cash, put it to work in 1-year treasuries and money markets and things like that. And then here comes September, things like we sold, and that we could get 6.5-7% on it again because rates changed again, and it was amazing. And those are the types of things you're talking about. You cannot do that with a bond fund, but when you're buying the individual bonds, you can do that. And worst case scenario, if it doesn't flip back and forth, you just hold it to maturity and you get the 7%, the 6%, whatever that is that you locked into when you bought the bond, and you just collect that in interest. But sometimes you can write it up, get 20% appreciation, sell out, and wait for your next opportunity. There's some cool things that can be done trading individual securities.
So Daniel, I'm not sure if I quite followed you 100% on that. I think what you were saying is that you were, July or so, we sold out of some of those bonds and put the money into cash or short-term securities that were paying some good money. Then in September, the deals came about, and those same things or types of things were actually good buying opportunities. They now came down in price so that we could buy again. So you sold while high, and then we bought this basically the same things when they were low again, right? Is that what happened?
Yeah, through September, October, November, right? The deals they presented themselves again. And so there was a bunch of opportunities. We're able to get out of the cash-like instruments and get into investments. And what I mean by investment is longer term, right? You're locking in these yields for, 6, 7, 8 years, depending how far we wanted to go out.
Excellent. Love that treasure hunt and stuff, right? Love that treasure hunt and stuff. Adds a consistency. Well, we need to go to a break, and you're listening to Financial Strategies with Andrew and Daniel Agemy. This father-son team coming to you because people don't know what people don't know. And we have a book that we'd like to give you so that you can yourself called The Retirement Income Source, The Ultimate Guide to Eternal Income by our friend David Scranton. This book is an easy read book that will be able to help you to understand the aspects of income and how income investing can not only just give you income, but it can also give you growth to be able to make sure that you are able to retire and stay retired and not run out of money. Yours for free by calling 800-725-7616 for your free copy of The Retirement Income Source. Call now.
The biggest mistake retirees make is not switching from the growth model to the income model. A good retirement plan is having enough income to last the rest of your life. Any problem in retirement, it can be solved with income. The biggest concern that retirees have is running out of money. The second biggest concern is that they want to grow their money. so that they don't run out of money. And they think it's synonymous when it's not necessarily the case. People don't know what they don't know. And they're not going to know unless somebody tells them. People think that the only thing that they can do to grow their money is by investing for growth in the stock market. And it's very much a herd mentality. But you can only get growth when the market goes up. When they invest for income, they're able to get money no matter what happens. I'm Andrew Agemy, founder and CEO of Agemy Financial Strategies. We've been helping people enjoy stress-free retirement for over 30 years.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
So we're recording this on Tuesday, January 21st, and yesterday I was listening to the inaugural address by our new president, President Trump, and he says that the golden age of America starts today, starts right now at 12:05 or whatever it was that he said that on January 20th. And, it's very interesting that he says that, and there's a lot of hope. There's a lot of hope in regard to certain people with Trump, but then there's also a lot of fear with other people in regard to Trump. And with that, the point is that, the amount of effect that the president has upon the stock market and upon investments is sometimes negligible. Other than, the stock market going up dramatically starting on November 6th of 2016, when Trump got elected the first time, there hasn't been really that dramatic of things within the stock market for so long. And one of the reasons why it went up so much like that is because there was hope, and the market hadn't really done anything for the past 2 or 3 years prior to that. It was basically flat. And then, even this time when Trump got elected, markets went up, but they didn't go up anywhere near as long or as dramatic as it was. And coming into 2025, what will that be? I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about 2024 in review and 2025, what's new. So AAA, there's a lot new in 2025 around the world and in the U.S., right? We got a whole brand new administration. We got the Avengers coming into office. People are calling them, right? It's all these people that could be presidents on their own that came together and they're building out this administration. There's a lot of hope. Right. Some people are worried about things as well. Right. But with change, right? With change always comes opportunity. We found opportunities under each president, as we've done this. And so what are your thoughts for 2025? You've seen a lot of different administrations over the years, and what are your thoughts going into 2025, and what kind of opportunities are you looking at?
Well, like I said there, Daniel, is that, what happens with the election of a president is not dramatically affected by the market. It went up dramatically with Trump. That was the first time really that it did any kind of thing like that. The stock market did any kind of, taking off like that. And then, when Biden got elected, there were a lot of people that thought that they were going to lose all their money. The market was going to drop right away. And he took office in January of 2020, right? And so then it wasn't until January 2022. So for 2 years, the market continued to go up, basically. And then 2022 is when it came down, and it just came down for the 1 year. Then it started to go up again. Of course, it didn't come up and back to where it was until January of 24. But, a lot of people thought that they were going to lose everything with Biden, and they didn't from that standpoint. But you never know what's going to happen, right? I mean, there's a lot of hope, like you said, Daniel, with this, right? We already got I heard it was 3 hostages back on the eve of the inauguration, right? And there's going to be more hostages coming back, which is a great thing. I remember, when Jimmy Carter was in office and the Iranian hostage crisis happened, and there were all these hostages in Iran, and nothing could happen. And as soon as President Reagan got elected, boy, those Iranians let those hostages go, right? And that was a whole nother thing. And so we've got some stuff that's before us, that there are going to be a lot of changes. What that means to the market, who knows, right? I mean, like yesterday, President Trump signed an order for all government employees to leave their homes, go back to the office to work. Instead of working from home, they had to go back to the office, right? And what do you think is going to happen? Well, I believe that there's going to be a certain amount of those people that are going to say, well, I don't want to go back to the office, and I'm not going to go back to the office, and I quit, right? And so then the job market, may fall apart. Unemployment may unravel with that, or it may not, right? It could go both directions. Same thing. The market could continue to go up in 2025 under Trump's leadership and under the hope that is there from that standpoint. But it also could go down because of just some of these companies just coming apart. I found it interesting to see so many people on the platform where President Trump was being inaugurated yesterday. Elon Musk, what's the guy's name? The president of Apple was up there, right? All these people giving $1 million, to the inauguration and all these things, right? Because they're wanting to get in Trump's favor from that standpoint. And will it prove to their favor? Will it not? I mean, Elon Musk, when President Trump announced that he wanted to put a man on Mars, put a flag on Mars, Elon Musk couldn't stand still, man. He was jumping up and down for joy, right? And I mean, not only is that one of his goals, but also obviously that will help him from the financial standpoint. But I think Elon Musk is more interested in the goal of the factor, and then with that comes the financial aspect. But a lot of these different things, but I'm talking and listen to Financial Strategies with Andrew and Daniel Agemy. Today, we have a paper we'd like to give you called The Importance of Financial Defense. We don't know what's going to be going on in 2025, but if you set your portfolio up with a defensive mechanism, a defensive strategy in it, maybe it's not the whole portfolio is defensive, maybe a part of the portfolio is defensive, right? Just like in any kind of game, you have to have offense and you have to have the right amount of defense as well. And if you don't, you can still lose the game. So with that, we want to put this paper in your hand, Importance of Financial Defense, yours for free by calling us at 800-725-7616, 800-725-7616 for your free copy of Importance of Financial Defense, this paper that we put together for you. You listen to Financial Strategies with Andrew and Daniel Agemy, this father-son team coming to you to help you to know what you don't know, because people don't know what people don't know. The egregious thing is when they don't want to know what they don't know.
Triple A, there is a lot going on right now. Change of administration, completely, new Treasury Secretary, this whole team like you talked about. There's a lot of hope and optimism built in already. I find it interesting that you were talking about, jobs. In the last few years, the government has kept the job number low by hiring internally in the government. And now there's this DOGE, right? Department of Efficiency. And they're going to supposedly be cutting back on U.S. spending, which is amazing because, did you know in 2024, we hit $36 trillion of debt? It's just unthinkable, right? Like that amount of debt. And so if think about as a family, if you're a family and you're living high and you're building up debt, you're living in a beautiful home, you're renting your Mercedes, you're going eating out at nice things, and you're building up your debt. And one day you decide you're going to cut the fat, you're going to cut the debt. Are you going to go through some pain before?
Yeah.
Before you get rid of all those interest payments, right? And so that's something I don't know that everyone's thinking about, is if Elon Musk and Vivek Ramaswamy are going in and they're cutting out the fat, there could be pain at some point. Maybe it's not for 6 months, maybe it's not for a year. But when you talk about that, and now the new Treasury Secretary understands finance and he understands that, and if they're going to try to cut deficits, right now I think we got about a $1 trillion a year deficit. We got about $1 trillion a year in interest payments. If they're going to be trying to cut those things, there could certainly be some pain before you get the economic benefits. We could be wrong, that could be wrong. There could be so much hope and optimism that we write up, and there's not. But when we look at like Argentina, for example, and their new president came in, he told everyone there's going to be pain, before we get the benefits. And he went in, he cut a lot of regulation, went in and cut, the debt, rebuilding the country. And so it could be very similar to what we see here in the U.S.
That's right. That's right, Daniel. And, many times you have to go through the desert before, the flowers appear and all the other things, right? And that's a very good point. But then you have the aspect of, President Trump saying, things like drill, baby, drill. Right. And, that we will be, other nations will be, looking for oil from us instead of us getting it from from other nations. And then you have things like the ERS, right? The External Revenue Service, where President Trump is planning to tariff and tax other nations if they want to do business with us. And, how that all comes about, well, we'll wait and see, right? But all these things can have positive and negative effects upon people's money. And that's where the importance of a financial defense plan and strategy comes into play. A purpose-oriented. If you're in and close to retirement and you're wanting to retire and stay retired, well, make sure that your portfolio is set up for defense. That's going to be able to pay you no matter what happens to the value of those underlying positions. And, sell high, buy low. This is a perfect time to get a second opinion, because if you find out that you put your finances under a financial MRI and you find out that they're not set up properly and that you got some cancerous cells, well, you can change and you can do some chemotherapy. You can do some financial surgery on that and be able to change that to be able to make sure that you don't have any losses with that. Be able to recategorize and re-strategize your portfolio to be able to make it fit and make it do what you want to do now that you're at the age and place in life that you're at. Daniel, you have any other things that you want to say before we wrap up here? This time is going by fast. It's time for us to wrap up.
Yeah. Think about that saying, as you get further and further into an economic boom, risk is my friend, risk is my friend. Stop and think if that's what you're thinking. When you're too scared to sell your S&P 500 because you're FOMO, you have fear of missing out, right? These stocks, just think, is risk my friend right now? Should we be, all the way on the risk spectrum? And if you think that there's a potential for a volatile year, how are you going to benefit from the volatility, right? One of the things we love over here at Agemy Financial is we love income. We love income because it gives you optionality. Now, this isn't for 30-year-olds. This isn't for 20-year-olds. This is for people who've already built up their wealth. We like income because when you go for income, what it does is it gives you invest by contract. It can protect your principal, and it can give you spending power. It can support your lifestyle throughout any market cycle because you can live off the income. Now, if you don't need the income, what it does is it allows you to take advantage of volatility because you always have cash coming in. We've seen a few $1 million portfolios recently, and they're generating $72,000 a year of income. $70,000 a year of income is serious income that you can reinvest, you can spend, you can do whatever you want with. You can wait until there's certain opportunities, right? When stuff blows off, instead of just saying risk is my friend, I've got my finger on the trigger. If you don't have your finger on the trigger, if you're somebody who just says I'm in whatever I'm in, you really need to evaluate because risk is not your friend right now unless it's very specific risk. The other thing is watch out for the big cap companies because they've done really well, and this Trump administration could potentially change that because, as you said when you went to the Mecum auction, there's only so much money out there and it's going to certain places. And so if money comes out of big companies and goes into small and medium companies, that could do some nasty things to big tech, and it could do some nasty things to things like S&P. So keep an open mind, do your research, look at history, and if you need some help, get a professional who understands history.
Excellent, Daniel. Good advice. So listen, as we close up, we want to give you this book, Retirement Income Source by David Scranton, the ultimate guide to eternal income. Love to put this in your hand for free. For the next 5 first-time callers at 800-725-7616, 800-725-7616 for your free copy. Call now. And, as we here at Financial Strategies say that, an educated retiree is a happy and stress-free retiree. Be happy and stress-free.